Zillow just sent a jolt through the U.S. housing market, and their latest forecast is the stuff of nightmares for both current homeowners and would-be buyers. The company is now projecting steep home price declines in cities that were once seen as bulletproof. And the data? It's nothing short of alarming. Pending home sales have dropped to record lows, buyer cancellations are spiking, and demand has slumped to levels even worse than what we saw during the 2008 meltdown. Properties that fetched $700,000 just a short while ago are now being sold for closer to $500,000, evaporating years of built-up equity in an instant. Skyrocketing insurance costs, rising property taxes, and an affordability crisis have pushed the system to a breaking point. These 10 cities aren't just cooling off, they're in free fall. And if Zillow's projections hold true, this could be just the start of a much deeper crash. Number 10. Washington, D.C. When the nation's capital starts to buckle under housing pressure, you know something's gone seriously wrong in America's real estate landscape. Washington, D.C. was once considered nearly recession-proof, propped up by federal jobs, big lobbying money, and a constant stream of government contracts. But according to Zillow's latest projections, even this fortress of financial stability is showing cracks, and they're getting wider. Why the downturn? Simply put, even the policy elites and power brokers who fuel the city can't keep up with the cost of living. The median home price in D.C. is now around $640,000, and that's often for aging row houses that still require $100,000 or more in renovations just to feel modern. Property taxes are steep, insurance costs are climbing, and wages in the region, while high on paper, aren't keeping up with the relentless surge in expenses. On top of that, the buyer pool is shrinking. Pending home sales nationwide slipped by 0.4% just in July, and cancellations have spiked sharply. D.C. isn't escaping that trend. Inventory is swelling at an alarming pace, with more and more homes sitting unsold for 60 to 120 days, a massive change from the lightning-fast sales of just a few years ago. Desperate sellers are now facing the music. One recent case? A condo purchased in 2022 for $720,000 just sold for $580,000, a stunning 19% drop in under 3 years. And it's not an isolated case. Zillow's pending home sales index has plummeted to 72, far below the pre-pandemic average of 106, and even worse than levels seen during the 2008 crash. The reality is clear. Washington, D.C. is caught in a perfect storm: stubbornly high prices, collapsing demand, and affordability that's already out of reach for most buyers. Even if interest rates drop, it won't be enough to revive the market. The math simply doesn't work anymore. This city's housing market was built on the illusion of endless federal spending. But now, even lifelong government employees are starting to jump ship. And if the capital of the wealthiest country on earth is unraveling, what does that say about the rest of the nation? Number 9. Cape Coral, Florida. Cape Coral used to be dubbed Florida's waterfront wonderland, but in 2025, it's starting to resemble the sequel to the foreclosure crisis. And this time, the warning signs are flashing bright red. Zillow's latest projections aren't pulling any punches. This market is heading straight for a painful correction. And the reasons? They're stacking up fast. During the pandemic housing boom, prices in Cape Coral surged at a breakneck pace. Back in 2020, the typical home would cost around $260,000. But by 2022, that number had soared to over $420,000, an eye-watering increase of nearly 62% in just 2 years. Growth like that simply isn't sustainable, and now reality is setting in hard. As of 2025, home prices are already sliding, down 8% to 12% year over year, and some pockets of the city are seeing losses topping 15%. But the deeper problem isn't just falling values. It's the cost of keeping a roof over your head. Insurance premiums in Florida have absolutely exploded. In many coastal areas, homeowners are now paying $6,000 or more per year for basic coverage. Add mandatory flood insurance, another $3,000 to $5,000 annually, and you're looking at $1,000 a month in insurance costs alone. And that's before a single dollar goes toward your mortgage. Understandably, buyers are tapping out. Active listings in Cape Coral have skyrocketed, up a staggering 65% compared to last year, and the market is now drowning in excess inventory. Builders, who flooded the area with new developments during the boom, are now panicking. They're offering discounts of $50,000 to $100,000, free upgrades, and other incentives just to offload homes. But demand has all but vanished. Even worse, pending sales are nosediving. Cancellation rates have surged past 15%, with buyers backing out the moment they get hit with the true cost of ownership. Think high insurance premiums, rising HOA dues, and hefty tax bills. Homes are sitting unsold for months. Price cuts are piling up, and the downward spiral is picking up speed. Zillow expects prices here to continue falling well into 2026, and honestly, that might be an optimistic take. With median household income hovering at just $63,000, it's nearly impossible for the average resident to afford a home now priced at 6 to 7 times their annual earnings. This isn't just a soft landing, it's a housing crash in slow motion. Cape Coral is a painful reminder of what happens when a real estate market inflates too fast, driven by hype, speculation, and wishful thinking. And now that bubble is bursting hard. Number 8. Portland, Oregon. Once celebrated as the artsy, livable gem of the West Coast, Portland is now flashing warning signs of a full-scale housing unraveling. Known for its indie cafes, progressive culture, and booming tech scene, the city once promised a more affordable alternative to places like San Francisco or Seattle. But in 2025, that promise is collapsing fast. Today, the median home price in Portland sits around $525,000, yet the typical household earns just $82,000 a year. That's more than 6 times the average income, double the long-standing affordability guideline that says housing should cost no more than 3 times what you make. In simple terms, Portland is officially unaffordable for most of the people who live there. Zillow's latest forecast shows home values in Portland are headed south, and there are several hard-hitting reasons behind the shift. First, let's talk taxes. Oregon has no sales tax, but it makes up for it with some of the highest income taxes in the country. And property taxes aren't far behind. Homeowners are typically shelling out between $4,000 and $5,000 a year just to keep their property. Toss in rising insurance costs driven by wildfire risk and inflation, and many buyers are simply stepping back, doing the math, and walking away. Second, supply is ballooning. Active listings have surged nearly 40% year over year, and the time it takes to sell a home has stretched beyond 90 days in many cases. Sellers who priced aggressively during the pandemic are now slashing asking prices, sometimes by $50,000, $75,000, or even 6 figures, just to spark interest. But here's the biggest red flag. Buyer demand is disappearing. According to the Pending Home Sales Index, Portland is seeing weaker demand now than at the lowest point of the 2008 crash. That's not a slowdown. That's a full-blown housing recession. And then there's the issue of livability. Rising crime rates, a worsening homelessness crisis, and a downtown riddled with commercial vacancies have pushed many residents to flee the urban core. The suburbs, once considered a refuge, aren't much better. Prices are still out of reach, and the cost of living continues to rise. Zillow expects prices in Portland to keep sliding through 2026, and unless wages suddenly spike, which seems unlikely, that trend isn't going to reverse anytime soon. Portland was once the poster child for balance, creative culture, job opportunities, and livable neighborhoods. Now, it's quickly becoming a case study in how even the coolest cities can overheat, overextend, and unravel. Number 7. Northport, Florida. Northport was once pitched as the ultimate retirement dream. Sun-soaked days, nearby beaches, and homes that seemed affordable compared to the rest of Florida. But in 2025, that dream is unraveling fast, and Zillow's outlook isn't just pessimistic, it's downright grim. During the pandemic housing rush, Northport saw prices explode. The median home value skyrocketed to nearly $400,000, a jaw-dropping 70% increase since 2019. The problem? Local wages didn't follow. The average household income in Northport hovers around $61,000, which means homes now cost more than 6.5 times what most residents earn each year. That's an affordability cliff, and buyers are already over the edge. Then there's the insurance crisis. Florida has become ground zero for the collapse of the homeowners insurance industry, and Sarasota County is feeling the full impact. Annual premiums now range from $5,000 to $8,000, and that's if homeowners can even find coverage. Add flood insurance, and you're looking at an additional $3,000 a year. For retirees living on fixed incomes, these numbers just don't work anymore. But the clearest sign of a downturn is the flood of listings. Inventory in Northport has surged nearly 80% in 2025. Builders are desperately slashing prices, sometimes by $50,000 to $100,000 per home, just to clear out brand new developments. The resale market looks even worse. Many homeowners who bought at the peak in 2022 are now underwater. One striking example: a home purchased for $450,000 just sold for $360,000, a crushing $90,000 loss in under 3 years. Zillow's projection for Northport is clear. This isn't just a dip, it's the beginning of multi-year declines. Why? Because the city's core buyer base is shrinking. The wave of baby boomers is receding, and younger buyers can't afford the bloated prices or steep carrying costs. Pending sales are cratering, contract cancellations are soaring, and demand is evaporating. Northport is a cautionary tale, a city that leaned too hard on inbound migration, cheap mortgages, and retirement dollars. Now, with all three drying up, the collapse has already begun. Number 6. Honolulu, Hawaii. Honolulu might look like paradise from the outside: swaying palms, turquoise waters, postcard sunsets. But beneath the surface, the housing market is cracking wide open. According to Zillow, price declines are coming, and the reasons are stacking up fast. Let's start with affordability, or rather, the complete lack of it. The median home price in Honolulu is now around $880,000, while the average household income sits just shy of $98,000. That's 9 times income, far above the sustainable benchmark of 3 to 4 times. At this point, it's not just a housing crisis. It's a financial impossibility for most locals. And people are responding the only way they can. They're leaving. Thousands of native Hawaiians and longtime residents are packing up and moving to the mainland each year, priced out of the very island they've called home for generations. With fewer buyers and a shrinking population, inventory is starting to balloon. Sure, Hawaii is known for its relatively low property taxes, but everything else is punishingly expensive. Electricity bills, food costs, basic household goods, all among the highest in the country. Insurance premiums are also climbing rapidly, especially in coastal and high-risk areas. And when you combine that with today's elevated mortgage rates, the monthly cost of owning a home becomes completely out of reach for most people. Then there's the tourism factor, the economic lifeline of the islands. Post-pandemic recovery has been sluggish. Job growth is stalling, wages have flatlined, and investors are pulling back. Why? Short-term rental restrictions are tightening, vacancy rates are rising, and profit margins are shrinking. Real-life sales show the damage. One high-rise condo in Waikiki, purchased for $1.05 million in 2021, just sold for $870,000. That's a $180,000 loss in just 4 years. And it's not an isolated case. Dozens of similar transactions are popping up across the island. Zillow isn't making a guess here. They're warning that Honolulu's housing bubble has maxed out, and a correction is not only likely, it's already happening. So what happens when paradise becomes unaffordable for the people who live there? You get what we're seeing now, a slow-motion crash where even a tropical view can't hide the reality. For many in Honolulu, owning a home isn't a dream anymore. It's a financial nightmare. Number 5. Denver, Colorado. Denver once soared as one of the brightest stars in America's housing boom. The promise of outdoor living, booming tech jobs, and postcard-perfect mountain views drove demand through the roof. But in 2025, the cracks are starting to show, and Zillow says they're only going to get worse. Let's look at the numbers. The median home price in Denver is now sitting around $600,000, while the typical household income hovers at just $87,000. That's nearly 7 times the average income, a ratio that's completely unsustainable. Back in the 1990s, Denver was known for being affordable. Today, it's a financial straitjacket. Inventory is spiking across the metro. Active listings are up a staggering 55% year over year, and many homes are sitting stale for over 100 days without serious offers. Meanwhile, pending sales are down 40% compared to the frenzy of the pandemic years. Simply put, buyers have tapped out. But sellers? Many are still clinging to yesterday's prices. Homes are hitting the market 15 to 20% overpriced, only to languish for months, then eventually take massive cuts, sometimes $50,000 to $100,000, just to get attention. Want proof? A home that sold for $740,000 in 2021 was just resold for $625,000, a $115,000 loss in less than 3 years. And it's not just starter homes feeling the pain. Even Denver's luxury sector is buckling. Areas like Boulder and Cherry Creek are flooded with multi-million-dollar listings, and barely any buyers in sight. And here's the real kicker. Monthly mortgage payments on a $600,000 home at today's interest rates run around $4,200. That's more than half of the city's average income. When housing eats 50% or more of your paycheck, affordability isn't just strained, it's dead. Zillow expects home values in Denver to keep sliding well into 2026, and honestly, it's not hard to see why. The math doesn't work, the demand isn't there, and the illusion of endless growth has finally hit a wall. The mile-high city isn't just leveling off, it's diving headfirst into a correction. And unless incomes catch up or prices fall dramatically, this once red-hot market could be looking at years of cooling ahead. Number 4. Sacramento, California. Sacramento was once marketed as the budget-friendly answer to Bay Area madness, a quieter, more affordable escape from San Francisco's soaring prices. But that narrative has flipped on its head. After a pandemic-fueled buying surge, Sacramento has become one of the most overinflated housing markets in the state, and according to Zillow, it's headed for a painful correction. Let's break it down. The current median home price in Sacramento sits at roughly $545,000, which marks a staggering 65% increase since 2015. But when you stack that against the median household income of just $79,000, the math gets scary fast. That's a price-to-income ratio of nearly 7 to 1, a level that experts widely agree is unsustainable. The warning signs are everywhere. Housing inventory has exploded, with active listings up almost 70% year over year. Homes that used to spark bidding wars are now sitting untouched for months. Builders, once riding high, are now scrambling to slash prices by $50,000 to $80,000, throwing in free upgrades, rate buydowns, and anything else they can offer just to keep deals alive. And even then, cancellations are skyrocketing. In July alone, Redfin reported that over 16% of contracts in Sacramento fell through, one of the highest rates in the country. Buyers are backing out after realizing the true cost of ownership, and many are getting cold feet before closing. It gets worse. Property taxes in Sacramento average around 1.25% annually, which means a $545,000 home will cost you nearly $7,000 per year in taxes alone. Add to that the surging insurance premiums, which have jumped between 25% and 40%, and you're looking at monthly costs that are anything but affordable. One real-world example says it all. A house purchased for $610,000 in 2022 recently changed hands for $495,000. That's a $115,000 loss in just a few years, a harsh reminder that this isn't a gentle correction. It's a full-on market reversal. Sacramento's bubble didn't just inflate, it burst. And this isn't just a local story. It's a signal that the housing crisis in California has moved far beyond the Bay Area. Zillow sees prices here sliding well into 2026, and with affordability shattered and demand fading fast, this capital city could become a major case study in what happens when a safe market turns upside down. Number 3. Austin, Texas. Not long ago, Austin was the poster child for the pandemic housing explosion. Tech giants were planting roots, West Coasters were flooding in to escape sky-high prices, and everyone seemed convinced that this Texas city was the next Silicon Valley. But in 2025, the shine has worn off, and fast. Zillow is now forecasting more losses ahead, and for many residents, the market's already in full-blown retreat. Let's talk numbers. At its peak in 2022, Austin's median home price reached a jaw-dropping $590,000. Fast forward to today, and that figure has plunged to about $485,000, an 18% drop in just a couple of years. And according to Zillow, the pain isn't over yet. They're predicting another 3.5% decline by 2026. But for locals, that future drop already feels like their current reality. Buyer interest has all but vanished. Pending sales are scraping record lows, while new listings have surged. Compared to 2021, inventory is up a massive 140%. That's not just a cooling market. That's a full-blown oversupply crisis. And here's where it really unravels. Investor activity during the boom sent this market into overdrive. From hedge funds scooping up properties to Airbnb hosts turning entire neighborhoods into short-term rental zones, Austin became a playground for speculation. But once tourism dipped and rental profits thinned out, those same investors started unloading properties at a rapid clip. Now, for-sale signs are sprouting up like weeds, especially in neighborhoods that were once investor hotspots. The bigger issue? Affordability has been wrecked. While the average household income in Austin hovers around $86,000, even with the price drops, mortgage payments still eat up over 45% of monthly income. The numbers just don't work anymore. Not for first-time buyers, not for families, not for anyone hoping to build long-term equity. Real examples put a face to the fallout. One property bought for $720,000 in 2021 just sold for $590,000, a $130,000 loss in less than 4 years. And this isn't an isolated incident. Multiply that across thousands of homes, and it becomes clear Austin's market isn't adjusting, it's collapsing. The hard truth? Austin's boom wasn't driven by fundamentals. It was a speculative bubble inflated by tech migration and ultra-low interest rates. But now, the tech layoffs have arrived, the cost of borrowing has surged, and the hype machine has officially run out of fuel. Austin isn't just facing a correction. It's becoming a case study in what happens when too much growth happens too fast, without the wages, infrastructure, or stability to support it. Number 2, San Francisco, California. If there's one city that perfectly captures the extremes of America's housing market, from explosive highs to alarming lows, it's San Francisco. Long considered the crown jewel of tech-fueled real estate, it became a place where even millionaires felt squeezed, thanks to home prices that soared into the stratosphere. But the tide is turning. Zillow is now projecting a 4% drop in values across San Francisco, but many insiders believe that estimate barely scratches the surface. Why? Let's break it down. The current median home price sits at a staggering $1.25 million. Compare that to the median household income of $127,000, and you're staring at a home price-to-income ratio of nearly 10 to 1, the worst affordability rate in the entire country. To put that into perspective, anything above 3x income is traditionally considered overpriced. San Francisco has tripled that benchmark. The inventory story is just as alarming. Listings have jumped nearly 50% year over year, and the condo market is leading the slide. Units in downtown high-rises that once fetched $1.3 million just a few years ago are now struggling to sell for even $950,000. In some luxury buildings, vacancy rates have crept above 40%, an unheard-of figure in one of the most expensive real estate markets in the world. What's fueling the fall? Tech layoffs are a major catalyst. Companies like Meta, Google, and Salesforce have shed thousands of jobs, draining the pipeline of high-income buyers that once kept this market afloat. At the same time, an exodus of residents has been underway since 2020, with over 250,000 people leaving the Bay Area. So now, both supply and demand are heading in the wrong direction. Add in a host of urban challenges, rising crime, visible homelessness, and a downtown core in decline. Retail icons in Union Square are shuttered. Commercial vacancy rates are over 30%, making once busy streets feel deserted. And yet, buyers are still being asked to shell out more than $1 million to live there. For many, that's a non-starter. Then there are the carrying costs. Property taxes on a $1 million home can easily exceed $15,000 per year. Insurance rates are rising fast, and with current mortgage rates, monthly payments for a median-priced home now surpass $8,000. That's enough to stretch even affluent buyers to their financial limits. Here's the part that really stings. Some homes in the city have already fallen by 20 to 25% since their peak valuations in 2022. So while Zillow's 4% prediction might sound modest, real-world data suggests this downturn could extend to a 10% or greater decline by 2026, especially if economic conditions continue to tighten. In the end, San Francisco is learning a harsh lesson. When a housing market is propped up by speculative tech wealth and fantasy valuations, a correction isn't just possible, it's unavoidable. The bubble didn't just deflate, it burst. And as of now, the descent has only just begun. Number 1. New Orleans, Louisiana. When Zillow waves the red flag over Louisiana, their spotlight is firmly on New Orleans. And for good reason. The stats paint a grim picture. This is a market that never fully recovered from the last housing crash, and now it's tumbling again, weighed down by sky-high costs, weak demand, and risks most buyers just aren't willing to take on. At first glance, the median home price of roughly $285,000 might seem reasonable, especially when stacked up against places like San Francisco or Honolulu. But don't be fooled. The median household income in New Orleans is only around $47,000, putting the home price-to-income ratio near 6 to 1. That's still well above affordability thresholds, and that's before factoring in all the extra expenses unique to this market. Let's talk about the real killer, insurance. Louisiana is now home to the most volatile and expensive homeowners insurance market in the entire country. In just 5 years, premiums have tripled, and many New Orleans residents are now paying between $6,000 and $9,000 annually. And that doesn't even include mandatory flood insurance, which can pile on another $3,000 to $5,000. After multiple hurricanes, insurers have pulled out entirely, leaving many scrambling for coverage or going without. Buyers see these numbers and just walk away. Then there's the constant threat of natural disasters. Every single hurricane season casts a long shadow over the city, keeping both buyers and lenders on edge. Owning a home here isn't just a financial decision. It's a high-stakes bet against nature, and that risk premium weighs heavily on demand. The local economy doesn't help either. Outside of tourism and hospitality, New Orleans offers few strong employment sectors. Wages have barely moved in the last decade, but the cost of living has surged, making it harder for residents to even think about buying, let alone staying in their homes long-term. Zillow's forecast calls for further price declines, and it's not hard to see why. Pending home sales are falling fast, and contract cancellations are among the highest in the country. Buyers are backing out after seeing the full cost breakdown, and sellers are scrambling to avoid major losses. Just look at the real-world examples. A house purchased in 2021 for $310,000 recently sold for just $250,000. That's a $60,000 loss in less than 4 years. Now imagine that pattern repeating across block after block, and it's no wonder the panic is spreading. Here's the bottom line. New Orleans isn't just a struggling market. It's the epicenter of America's housing affordability crisis. With rising insurance premiums, stagnant wages, natural disaster risk, and shrinking buyer demand, the city is facing a storm it may not recover from anytime soon. And while Zillow's outlook is already bleak, it might still be underestimating the depth of the collapse. This isn't just a housing dip, it's a slow-motion drowning of an entire market.